Hello everyone, my name is Kareem Haider, and today I'll be presenting to you the article under the title Above the Crowd. It was written by Bill Gurley on the 24th of May in 2011. So let's start by presenting the outline of my presentation. We'll start by a little introduction. We'll move next to the keys to the 10x Club. We will take LinkedIn as an example. We will then add four more keys and we'll finish by a little conclusion. So let's start by what the article started, which is all revenue is not created equal. So what are the 10 keys to the 10x revenue club? Uh, let's start by a little introduction, which is how do we evaluate a company? So many will say that the revenue or the price over revenue or price over sales ratios are the best way to evaluate a company because it was a trend during the internet bubble of the late 1990s. In fact, it's a dangerous technique because all revenues are not created equal. So if we talk to a finance person, he will surely adopt the DCF, which is discounted cash flows method, but it has also its own limitations because it's nearly impossible to predict the long-term cash flows because of a vast number of disparate future variables, so there is no accurate inputs. And many others will adopt, or many more analysts will adopt the other shortcuts, just like the price earnings ratio or the enterprise value to EBITDA. But these shortcuts also have their own benefits and limitations. Actually, a company's revenue alone is a very poor guide for its valuation. So, what are the 10 keys? What are the keys, sorry, to the 10x club? The first key is sustainable competitive advantage. We will talk about Warren Buffett's moat. The second key is the presence of network effects. The third one will be visibility and predictability are highly valued. The fourth key will be customer lock-in or high switching costs. The fifth one will be gross margin levels. The sixth point is marginal profitability calculation. The seventh one is customer concentration. We'll move next to talk about major partner dependencies and organic demand versus heavy marketing spend. And we will finish by the most important one, which is growth. So let's start by talking about the first key, which is sustainable competitive advantage. And we will talk about Warren Buffett's moat. So in this key, we should ask ourselves how easy it is for someone else to provide the same product or service that you provide. So this is the main concept of this key. Imagine that the castle in the picture is the company. The water body surrounding the castle is the moat, which is the protection from attackers and who are competitors to the company. And this is what Warren Buffett meant by Warren Buffett's moat. So as an example, we will take into consideration Coca-Cola versus Ream. Coca-Cola, who has a 5% estimated 2012 growth rate, and Ream has a 12% estimated 2012 growth rate. Coca-Cola has a 3.6 price over revenue multiple, while Ream has a 0.77 price over revenue multiple. In fact, investors expect the form of the company 50 years from now with confidence for Coca-Cola, while there is no confidence for Ream. So let's move now to the presence of network effects. The main concept or the main idea of this key is that the winner takes all. In Brian Arthur's Increasing Returns and Two Words of Business published in HBR in 1996, what Brian Arthur meant by the second word is where the market leader has an unfair advantage reinforced by network effects. As examples, we could take Microsoft, eBay, Skype, Google AdWords, or Facebook, who all benefited from network effects. So The third key is visibility, predictability are highly valued. The concept of this key is that a high level of predictability and consistency in the future is far better than low level of predictability and consistency in the future for a company, because more certainty of future cash flows will let us have a higher premium, and this will result in a higher price over revenue multiple. As an example, we can talk about the SaaS subscription revenue, and the opposite of that is a one-time or episodic revenue, such like game companies. Actually, game companies adopt the many game companies, not all of them for sure, adopt the hit concept, which is that they upload a game or an application that will hit the market. It will generate a lot of revenues because of its downloads and its use, but it will be a one-time revenue, so no subscriptions. So the fourth key is customer lock-in or high switching costs. The concept of this key is that we should retain customers for long periods of time. For non-subscription models, an easy switch will result in a low price over revenue multiple, while a difficult switch will result in a high price over revenue multiple. So this will let the company have stronger pricing power, longer customer life, and of course, a better discounted cash flow dynamics. So while for subscription models, low churn customer will result in a high price over revenue multiple, and a high churn customer will result in a low price over revenue multiple. So what are the switching cost forms? We can talk about many forms. Uh, Technical lock-in, data lock-in, high startup cost with a new vendor, downstream revenue dependencies, etc. We can say that high switching costs will result in high price over revenue multiple, while low switching costs will result in low price over revenue multiples. Let's move now to talk about the gross margin levels. Actually, here we should mention that high gross margin companies are far different from low gross margin companies, even though it is a basic concept. Uh, Using a discounted cash flow framework, large variable costs will result in no big amounts of cash from the revenue stream, so lower gross margin companies will trade a highly discounted price over revenue multiples. As an example, we can talk about Amazon, who has a 20% gross margin, who trades at a low of 1.5 in 2012 revenue estimates. Walmart, who has a 25% gross margin, trades at only 0.41 in 2012 revenues. And Best Buy, who has 24% gross margin, trades at only 0.22 forward revenues. So, as a conclusion, all things being equal, gross margin percentage should have a direct impact on price over revenue multiple, as there will always be more gross margin dollars to contribute to free cash flow. So, gross margin levels should be taken into consideration in analysis done by journalists or analysts. Oh, we forgot to mention the gross margin formula, which is equal to the net sales minus COGS, which is cost of goods sold, over net sales times 100. The sixth key is the marginal profitability calculation. Here we should say that investors are in love with companies with scale. Investors love companies where all things being equal, higher revenues create higher profit margins. So in order to measure how a business is scaling, we should think of the marginal incremental profitability on a quarter over quarter or a year over year basis. So the first step is to look at the change in revenue versus the change in cost. And the second step will be to calculate the incremental operating margin of the two results. If the marginal profitability number is higher than the historical profitability, we're in a good position, we have a good scale. And if the marginal profitability is lower than the historical profitability, here there is a red flag. We should pay attention. We have a bad scale. And we can talk about Google as an example. Google stated on its earnings call that the company was simply investing for the long term, over the short term and was not concerned about this trend. But investors viewed things differently and sent the stock down $48 the next day, representing a 7% fall from 578 to $530 per share, as you can see in the table below, sorry. So the seventh key to the 10x club is customer concentration. The concept of this key can be assumed by all things being equal. A highly fragmented customer base is better than a highly concentrated one because customers with large percentage of the revenue will have market power and they will have demands over time concerning the price, any feature or a service. So this will result in a negative impact on discounted cash flows over time. So we have another situation where the top two or two to five customers organize against the company, and this will result in a limitation of pricing power for the company. So if we want to talk about the ideal situation, it is when the company has tons of small customers who are price takers in the market. As an example, we can talk about Google's AdWords program. As you can see in the picture, only two persons are more valued than for others. So if it was in a company, these two can have more power than the four others. So let's talk now about the major partner dependencies, which is the eighth key to the 10x club. The concept of this key is that being heavily dependent on another firm or partner will result in a lower price over revenue valuation, and the opposite is true. As an example, you can talk about demand media's reliance on Google's SEO traffic. In this example, Google can heavily impact the outcomes for demand. It can also have drastic impact on long-term valuation and therefore price over revenue multiple. Actually, these dependencies are also disclosed in the S1 under risk factors. In this picture, imagine that one of the four persons beside each other falls. We can surely say that three other persons will fall. So it's a big risk being dependent. The ninth key will be organic demand versus a heavy marketing spend. The concept of this key is that all things being equal, a heavy reliance on marketing spend will hurt your valuation multiple. So we consider that the word of mouth is far better than advertisement and promotion. As an example, we will talk about what Jeff Bezos said. Jeff Bezos said that about 3 years ago, we stopped doing television advertising. We did a 15-month long test of TV advertising and it worked, but not as much as the kind of price elasticity we knew we could get from taking those ad dollars and then giving them back to consumers. So we should say that Wall Street will pay higher valuation for the one with organic customers than the one with substantial marketing. So, in the author's opinion, and in my opinion too, organic growth for e-commerce will win over paid marketing. The 10th key and the final one is, and the most important one also, is growth. The concept is of this key is that the faster you are growing, the larger and larger future revenues and cash flows will be, which has direct implications for a discounted cash flow. So there is a big correlation between growth and valuation multiples. But we should pay attention because growth by itself might be misleading. And here we should mention the idea of profitless prosperity, which is easy manufacturing of revenue growth. Let's have a little example. Imagine that I am selling a dollar for 85 cents. Actually, all customers and all people will rush because it is so beneficial for them. They will win $0.15 or 15 cents without doing anything. So it's very beneficial for them. So they will rush and I'll have a big growth and I'll have a big number of revenue while losing money because I'm doing a below market offering. So, as a summary, we'll take LinkedIn as an example, which is one of the best examples for uh, talking about the 10 keys to the 10x to the 10 revenue club. So, LinkedIn uh, has a very sustainable competitive advantage. It has high barriers to entry because it is very hard to launch a competitor as no value to new user of new system. LinkedIn benefited from network effects. It is one of the rare few strong network effect companies. LinkedIn has many revenue programs that are subscriptions, which is a good point for the visibility and predictability of the company. Concerning the customer lock-in and switching costs, it might not be technically hard to leave, but there is no alternative for the data they provide. So why leaving? So if you want to talk about the gross margin levels, it is over 80% and increasing, which is a good point. Concerning the marginal profitability, it was good in Q4, it reversed in Q1-11. So there is one red flag here, and LinkedIn should pay attention to that. Uh, concentration, concerning the customer concentration, there is none, which is very good. Concerning the partner dependency, there is no major ones, so we're on the safe side. And if you want to talk about the organic demand, it is there is little spent on marketing. So, and if you finally want to talk about growth, it is 100% plus. So, in conclusion, LinkedIn is a great example for a company that is very good at these factors that we talked about earlier. So, after 2 days of releasing the article, the author or the writer decided to add four more keys to what he mentioned before, and that is due to the reader's feedback and his own thoughts. The first key he added is the capital expenditure intensity. The second one is cash flow over earnings. The third one is optionality, and the fourth one is total available market. So if we want to talk about the first one, which is capital expenditure intensity, we can say that the concept of this key is that all things being equal, a company with heavy capital expenditure will trade at a lower price over revenue multiple. This requires constant funding, and as consequences, we should dilute shares through increased offerings or use our earned cash. And the formula for the capital intensity ratio is equal to capital expenditure over labor costs. So the second key he added is cash flow over earnings. The concept of this key is that higher cash over earnings ratio, the better we are. Uh, as a if we want to talk about the company's position. So how to do it? We should collect cash from customers ahead of accounting-driven revenue recognition. If the cash margin is higher than the accounting net income margin, this will result in higher valuation multiples, and the opposite is true. The third key is optionality. The concept of this key is that a company, due to its market position, can have the optionality on a new business. As an example, we can talk about Amazon, who was trading at 1x revenue and launched AWS, which is Amazon Web Services. Uh, AWS was an option on a new business, so there is a new valuation for the company, Amazon. The fourth and final key and final point of my presentation is TAM. What is TAM? TAM is total available market. As a definition, we can say that it is the total market demand for a product or a service. In the writer's opinion, most companies suffering from TAM can never make it to the public market. So TAM affect private companies' valuation more than public ones. At the end of my presentation, I should thank you for listening to me, and I hope you enjoyed my presentation. Have a good day. Thank you.